What is up, beautiful people and wealth pursuers? In this video, we're going to break down how to manage $100,000. Now, I grew a six-figure portfolio over 7 years of investing, working a regular 9-to-5 job. I guess my job's kind of not that regular. I work with kids on the autism spectrum. It's a lot of fun. It's a big blast, and it's better than your job. At the end of the day, I don't get paid six figures at my job, yet I was able to build a six-figure portfolio. Part of that is that I always thought a few steps ahead. What am I going to do when I have $50,000? What am I going to do when I have $100K? What will I do when I have $250K? And luckily, I hit all of those thresholds. Now, you are either already six figures full of wealth and just trying to get new perspective or some ideas. Maybe you're on your way to get to that point and you want to be ready, because most people, they're not ready. And that's why money doesn't come to them. And that's not the ultimate truth, but it's a truth. Money comes to people who are ready for it, who will know how to manage it. I know people who have had tens of thousands of dollars come their way, and instead of turning it into $60,000, $80,000, $100,000, they turned it into $0. People get millions of dollars all the time, and they find a way. It takes a lot of work and turn it into $0. Hopefully you don't want to be one of those people, or you at least want to have the skill sets to manage money. This is not financial advice. This is completely my opinion, your education and entertainment reasons only. And if you want to subscribe to the channel and follow my journey, I'm Georgie. I am a board certified behavior analyst, and I am grinding through my job, loving every step of it, but investing as much money as I possibly can to build a work optional life by 2030. So I am no longer reliant on any employer but myself. If that sounds good to you, let's go ahead and get started with the video. Like Charlie Munger, one of the greatest investors of pretty much all time, definitely top three, for sure top three, during our modern era of stocks, because of course people have been investing for generations and generations and thousands of years way before stocks, and now it's way easier than ever before. So $100,000, he says, it's basically a lot to get to this point. You have to do whatever you can to get to 100K, work on the weekends, maybe take an extra shift, whatever it takes, be as frugal as possible. Don't spend money on things that don't bring you happiness. I mean, that should just be a framework for life. But once you finally reach $100,000, Charlie Munger says you can basically rest off the gas and take it easy, enjoy the sights, etc., because when you have this much money, it will start working for you this much more. So putting $100,000 to work in the market is a lot more, basically, return dollar-wise that you could receive than if you have, $1,000 or $10,000, which are huge accomplishments, especially for the United States population, where a majority do struggle with four-figure amount, five-figure amounts, just like a blessing. So if you are thinking about 100K right now, you're already amazing, because even if you don't have it, just thinking what you would do with it is a huge step, because most people, they don't think about this, but you're not most people. That's why you're subscribed to this channel, because most people aren't. $100,000, the first thing that we do is we cover our bases, right? So to cover our bases, we need about, I would say $20,000. So this is about 20% in cash. So this cash has a specific purpose. It's not just going to be sitting there. From this cash pile, we're only going to have $5,000 sitting there, which leaves us with 15K cash. So I'll explain this in a second. Our cash has different jobs, just like our money in the market has different jobs. So the 15K cash is going to be the interesting amount. This 5K, this should cover anywhere from 1 month to 2 months. And if you're very, very frugal and you know what's up, and you got your costs kind of lowered as much as you can, this could even be 3 months. I know a guy. But 15K, what you're going to be doing with this is you are going to be opening up bank accounts, investing firms, and you're going to be churning this. So this should bring you a nice, at least a $600 profit. How? There's Chase Bank, for example. I'll leave some links in the description. I'll leave a whole PDF file that you guys could go through and collect at least $600 worth. You're parking this money in reputable organizations like Chase Bank, Bank of America, etc., etc. Reputable. And then after that, you're just gonna cash out. It's as easy as that. There are some rules to this, like hold your money in here for 3 months, hold your money in here for 6 months, have your direct deposit, etc., etc. So this is how we're gonna get that nice, clean return without really risking our money in the market. And this serves as the back end of our emergency fund, which means that we can just forego this $600. Let's forget about this. It might be $1,000, could be $2,000 if you're good at churning. Your boy is pretty good at churning. Your boy made about 10 grand churning in the last year and a half or so. So I know what I'm doing when it comes to churning. With 15K though, look, an emergency could happen. You could lose your job. Who knows, right? You could get ill. You're gonna need this money out. So that's why we will forgo that 600 or 1,000 or 2,000, and we're gonna take that 15K and put it back in this 5K pile. Right as soon as you see that 5K pile is being touched, then you might want to take this 15K out because you don't know what's going to happen. But that's the cool part about churning. If you really don't want to keep the bonus money, then you just take your original money back out. So that's the easy part, right? Now we figured out what to do with our cash. We're actually going to have a third cash component that we're going to talk about the end, another pile for a cash. Now, my nose is a little stuffy because your boy actually has COVID at the time of recording this. So drop a like if you support the hustle and enjoy this type of content. Now, the next thing we're going to do, we're just going to make the easiest move possible, right? We're going to take this is going to be a huge chunk of our money right now, okay? So we're going to take, let's see, we're going to write in $50,000. Now, this is not financial advice or anything like that. This is just my opinion. This is something that I would do if I had 100K sitting in front of me right now and I had to make some decisions quickly. Now, my decisions might be a little bit different because one thing this example is not considering at all is what's the cash flow, right? What are we receiving from our jobs or our businesses, which is also our jobs? I'm not accounting for that. That would be impossible. Too many variables. This is just a fun exercise of what to do with 100 grand. So I would take 50K and I would do the easiest thing and just put it into index funds. So this is going to be our index money. Let's see, index. Oh, that's disgusting. Control Z. Oh, you can't control Z on here. That's nice. That's nice. So let me try writing this elsewhere. Maybe right over here. We're going to take, let's see if I can scroll this. There we go. We're going to take $50,000 and put that into index funds. So now what we have here is about, what is that? 70% of our money is used up. So now the fun part begins. We're left with a little bit less than 1/3 of our money, our 100,000, so about $30,000. This is where that riskier stuff is going to come in, and we're going to start right ahead with the most thing that we have to do. We want the most amount of money possible out of this last 30,000, so we're going to throw it into the account that lets that happen. And I'm talking about the Roth IRA. Now, we can't put in all 30,000 in there, but we can put in, at the time of the recording this video, 6,000. Now, in a couple months, we'll be able to put in 6,500. So let's go ahead and, for the sake of this example, put 6,000 into the Roth IRA. Now, are we done? No, we're not done. That 6,000 is not invested. What the heck are we going to invest that in? Well, the Roth IRA comes with a bunch of tax advantages, and we're going to take advantage of these advantages. IRA should stand for individual retirement advantage, because we are taking these advantages. So we are going to put this into dividend paying companies. Now, I want you guys to actually go out and do your own research, of course, into which dividend companies you'll put in. But there is an easy way to do this as well. Instead of trying to get the most amount of money, I'm going to get the most probable amount of money while still kind of balancing for risk. So we're actually going to stop sharing this screen. We'll come back to it. Oh, maybe we won't come back to it. Maybe I deleted it for good. I think I deleted it for good. We will check back with that later. I have the numbers memorized anyways. But what we're going to do is go to Yahoo Finances, and we're going to take a look at the Schwab US Dividend Equity ETF. This thing is amazing, right? Everyone talks about VOO, VTI. If you're not familiar, those are the top 500, top 3,900 or so companies in index funds, right? But this is a different type of fund. This is a dividend god. Look how much of a god this is. Right now, it pays a 3.36% dividend, which is about, I think 30% more than what VOO pays. Let's just check real quick. VOO pays 1.6%. So are we getting twice as much? And note this, VOO is down 15% year to date. Now, if we go back to our boy right over here, SCHD, we're going to see that this pays a 3.36% dividend. So we're getting more than double, kind of locked in there. And we're also getting less volatility with that beta. And when we compare that to our year-to-date loss, it's only minus 3.3%. And because of the dividend yield, bro, we lost no money. Or sis, right? Sis. Because I think this channel is doing pretty well with the male, female, and everything in between, and on the sides divides. This is a inclusive channel, right? I don't care what words you use, what language you use, but here we go, guys. This is amazing. Let me just show you the history of this real quick, okay? Let's look at the 10-year average return, 14.1%. If you guys invested in this during the last 10 years, getting 14.1%, that's millionaire money right there. Guys, this outperformed the market. Stable dividends outperform the market, especially when things are bad, right? This year alone in 2022, it's going to outperform the market hard unless we have some miraculous recovery. I don't know if we can see that in the next 2 months, although it is possible, right? It's very possible. It's not probable, but it could very well happen. So either way, though, you did fantastic if you were invested in this, just defensive wise, right? It's not just defensive though. You are getting a strong dividend pull. So yes, this is what we're buying inside of our Roth IRA, SCHD, or we could buy real estate investment trusts as well. One ticker symbol for that I really, really appreciate is Real Estate Income Corporation, Realty Income Corporation, which pays a very, very handsome or beautiful or anything in between and on the sides, a dividend yield of $2.98. Now, this dividend yield, in my opinion, is more stable than what we saw from SCHD. Now, the reason is that's a fund. This is an individual position, which means that this number is agreed upon. So you are locking in that 4.62%. Now, when it comes to a fund, there is no dollar amount that's agreed upon because it's so many different companies. We are getting an estimated percentage, and we're okay with that. We're happy with that. It's a solid percentage. This pays out more. But it is a lot less stable, right? Let's see where we at year to date. Does it even show us year to date? It should show us year to date. Are you guys seeing it? Because your boy's definitely not seeing it. How much are we down year to date? There we go. Maybe I need to type that in. I don't think that information is here for some reason. It should be. We are, yeah, I don't know. But let's see where we're at right now. This is at on the phone app. It does show you right away. So Yahoo Finances, please, can you update your desktop version? We're at $64, and about a year ago it was $71. So that is a drop of about, I want to say, close to 10%, which still
beats the market. And on top of that, there's a 4.62% yield as a shield. Yield as a shield. Yield. That's pretty good. I gotta write a song about that. Don't forget to look up your boy on Spotify, Funancialism. I got you guys. All your birthday parties. I used to do birthday parties, if you can't tell. Let me stop sharing and go back to that whiteboard. Come on, whiteboard. Still be there. Are you gonna be there? Oh my gosh, we're still here, baby. So Roth IRA, let's write that in. S C H. Don't forget the D, baby. So there we go. Right now we have about 76% of our funds invested. Okay, guy, I could hear you. I hear you being bothered by that little squiggly right there. I got rid of it for you. So drop a comment and say, hey, thank you for reading my mind. I know this isn't live. This is a pre-recording, but you still read my mind, and I appreciate that. And I appreciate you for being a subscriber. I especially appreciate you for all the watch time, right? You watch this video all the way, then you put it in slow motion and walk away from your computer. That's what I really appreciate. Thank you so much about that. We're gonna go a little bit degenerate here. This is where I'm gonna lose a lot of you, and I saved this till the end because I believe it is the correct choice. Now, is it gonna reward you the most? I hope so. So let's see what happens. Not financial advice. We're gonna go ahead and we're gonna take 10% of our 100K. So that is $10,000. We're going to take $10,000. We're going to go back into the brokerage account. This is where we have our 50,000 in index funds, right? Just the market. We just half our money went into the market as the market. Now that $10,000, what we're going to do with this, there's actually two groups that you could divide this by. One is the tech group, and the other is the industry disruptors. Did I spell that right? Again, this isn't an English channel. This is a finance channel. So we're going to spell things wrong all day. That's why stock people use ticker symbols, right? There's no way we can type out whatever SCHD actually stands for. Charles Schwab, dividend sec. Okay, guys, enough fooling around. What stocks are we actually buying? These are individual positions. Now, your boy is going to say, this is dangerous because you could have a great company, right? You could have a powerful company. Let's just take Sony as an example. And if you look at Sony's stock chart, and let's go ahead and actually do that. Let's type in Sony right here. There it is, guys. Let's take a look at this. $80.39. What does that say, right? Price is relative to itself. So let's take a look at where Sony was 5 years ago. 5 years ago, it was trading at $44. You doubled your money. Sounds good, right? Amazing. Well, let's take a look at about 20 years ago. Bro, in 1999, and sis, and everything in between and on the sides, November 1999, Sony was trading for about 50% more than it is today. Actually, more than 50% more. That's some quick math right there. We're going to stop there. I'm still trying to do the math in my head. How much more? That's about what, 53%, 54% more? That's pretty gnarly right there. It was trading at $126 per share. Now, anyone would say, hey, this thing crashes, right? It's a huge company. A lot of people love PlayStations. We're not going to know that. It's going to have a huge breach around 2005, I believe, where a lot of information and data was lost. And the only reason that I know that at the top of my head is because when I was playing in the backyard of one of my mom's best friend's boyfriend's house, pause, hold on, I know that sounds like a creepy story. I promise it's not. He was a great guy who happened to be responsible when Sony had a huge data breach, and I hope he's doing well. I think he's doing well. But yeah, man, one time we went to Hurricane Harbor, and they lost me there. And they thought I was having fun on the slides. I went to the lost and found. So if you're a kid who's like 10 and you get lost at Hurricane Harbor, let me tell you one thing. Do not go to the lost and found. You will have a miserable time coloring while your family and your friends, they're riding all the rides. No, you go and you ride those rides. Wait in line by yourself and do what you have to do. But no matter what, don't go to lost and found. Let your family be worried. They lost you, right? You're only only 10. What are you supposed to do? Not get lost? Anyways, that's why it's dangerous what I'm about to say. Not that you're going to get lost at Hurricane Harbor watching this, but that $80 a Sony story going from needing a 50% jump to get to back to where it was. Sheesh. So I'm going to stop sharing again, go back to that screen. Where to go? My whiteboard that does not erase. We're actually going to get some tech stocks. So I would go ahead and get some big guys. This is just an example, right? How am I doing this the hard way? Meta, right? That thing is down a lot right now. Google, that's another one it's a strong company, right? A lot of people are excited about the lower price that it's at right now. When it comes to Meta, though, there are a lot of haters. A lot of haters. The moat, right? Meaning, what's special about Meta is that they have a lot of users. Are those users happy? I don't know. They have a lot of data, but there are other companies that are exploring the metaverse. There are other companies that are in the NFT space. Now, are they as powerful as Meta? No. But was Meta as powerful as Meta 20 years ago? Also, no. So that's just something to consider, right? I wouldn't go too hard and put 10K into any one of these. Now, what are industry disruptors? So industry disruptors is something what Meta or Facebook used to be. Now we have new dogs coming up. And some example would be like CRISPR, right? You could find a lot of these inside of the Cathie Wood funds, the ARK funds. However, those are not too popular right now because they went down in price quite significantly. And I'm okay with that. Honestly, if it wasn't for the high expense ratio, I would probably be buying some. But I don't like paying fees, and neither should you, because like our boy John Bogle, oh, definitely one of the top 3 investors of all time, right? We have Charlie Munger and Jack Bogle in that top three dudes right there. I think both of them are the top 3, right, on their own. Shout out to Warren Buffett, Peter Lynch. There's definitely other great powerful investors, but Jack Bogle, he would say, Cathie Woods. Wait, that's Warren Buffett. Cathie Woods. I don't know what Jack Bogle sounds like anymore. The American investor. I'm stuck on Warren Buffett. But he would say that we definitely got a problem here with these absurd fees that could go up to 1%, robbing you of your wealth. 1% basically on $500 a month is $1 million over 40 years. And Jack Bogle makes sure that you can save that by reducing fees. And we see Charles Schwab kind of borrow from that idea. So I wouldn't buy the ARK funds, but I would buy what's inside of it. Companies like Edit, which are gene splicing, all that. Biopharmaceutical companies, we see them having huge spikes. They are down quite a bit from their all-time highs. I'm talking like 80% down. Now, what else is 80% down this year that we're going to put our money in? We are going to put our money in. Whoa, I got excited there. 4% or $4,000 into crypto. Onimos. If you watch South Park and you remember that Christmas special episode that they had a couple times with the magical animals, right? That song's hilarious. Crypto, onimos. Okay, so this crypto, right? I would break it down like this: 1K into BTC, so Bitcoin, the big daddy, and then 2.5K into Ethereum, the other big daddy, or mommy, or anything in between, or on the sides. And after Ethereum, I would have $500 left over. Now, this 500 would go into altcoins, such as even I would be generate, and I'm gonna say ape. We have ape staking coming soon. We'll see what happens with that. Right now, everyone's running away from this crypto space, but I believe that's why instead of investing like 1 to 3%, we're gonna go with 4 to even 6%. You could even go as high as 8%, but just know, right? this could die, this could disappear, which is why I'm like, okay, most of this is going to go into the blue chip cryptos, and then a very tiny percentage of this, okay, I guess it's not tiny, it's like 25% of this is going to go into, wait, 25%, my math's off, 12.5% is going to go into ape, and then I'm a big fan of AVAX. That thing's down a lot. I would stay away from Solana right now, but that's a different TED talk. So with that being said, this still leaves us with some money. And so far we have 4K plus 6K, that's 10. Another 10, that's 20. 20 plus 20, that's 40. That's 50. We're left with $10,000. Now, remember when I said that cash is going to have a third bucket? Okay, I don't believe cash is king, but opportunities do arise, like on unbelievable opportunities, especially in the NFT space. And we have $10,000 left over. Let me write that in right here. Another 10K. This is our opportunity fund. So this is to be spent in the year. This is extremely important. You will have to rebuild your opportunity fund. If we do not spend this 10K, if we don't find a way to be successful with it, we're putting it into index funds before the year ends. So for New Year's, or preferably a couple days before New Year's, if you haven't found a way to move this 10K, you're putting into index funds, and this is going to become a 60 real quick. I can't change that for you, but it is what it is. So how are we moving with this opportunity fund? Well, here's what I would do with this. I would break it down into a couple different categories, and my favorite category would be NFTs. This is where I lost like 1,000 followers on Instagram and a lot of legitimacy, but I put my money where my mouth is. I have money in NFTs, but mostly for flipping, and I have made at least every dollar that I have lost. So everything that I learned from NFTs, if I could start over, man, your boy would be in the profit without psychic powers, right? Just using principles. So you go for drops. And these drops happen on apps like Vivi, on DC Comics, the NFT space for that. Basically, something like $10 comic, right? For example, we had the Superman comic. If you hit the legendary mega ultra special sparkly Superman comic, and you could tell it's a good one because it says this is the NFT official version from DC Comics 1939. You don't gotta understand comics to understand that 1939 Superman is something special. So it's something. You're gonna take those $10 and you're gonna try to buy it. And if you can't buy it, well, now you have a second chance because the secondary market opens up. Now, if you're early on the secondary market, get your gun ready. I mean, get your snipers ready. And you're gonna be sniping. Pop, pop. You're gonna snipe opportunities. For example, here was the opportunity with the Superman one. Your boy didn't really think through that, like, hey, I'm on this app a little bit early. I could buy these NFTs before the masses come swarming in. And I'm not talking about like years later. I'm talking about like a few hours later. So the Superman NFT, the super mega ultra awesome one that some people pay $10 for, they were selling it for $2,000 just about an hour later. So you take 2K from your opportunity fund and you wait for the next wave of people who log onto the app like 3 or 4 hours later, who will be like, what? That's going for 2K? It actually wasn't going for 2K anymore because those people were buying it up. Your 2K would have been 8K by the end of the day. Now, I'm not saying that this is easy. I'm not saying that this is liquid. I'm not saying this is risk-free. I'm saying it's an opportunity, right? I would not go past $2,000 from your opportunity fund with these NFTs, even on the drop, the secondary market version of it, at least. The Superman story is not a one-of, right? This happened time and time again. There was the Spider-Man comic that was about $200 on secondary market, 180 to 200, and about a few days later, it was going as high as $800. Now, right now, I think it's trading a solid 400. So even months later, the price is still holding strong, and it is X2, where you were able to get on the secondary market. Now, here, what we have to think about, why 2K? We have 10K for this. Well, Think about our dividend position, right? We get 3%, a little bit more than 3% here. We get 1.7% here. We're going to get a nice return from our cash that's being churned. And of course, our crypto, we're not staking that anymore. The market is too volatile for there to be staking. And your boy will say, hey, I was wrong to be staking when it was not worth it to be staking, right? You're not going to risk $4,000 for a $4 like return, or even a $40 return per year, no matter how high the yield is. You're just not going to do it. It's not worth it. Even on Coinbase, I would be wary about that, but that's also a different TED Talk. So why 2K? Because it matches your dividend yield, your average dividend yield. That's why 2K. It'll Y2K. It'll cancel a pause. Illuminati confirmed. It'll average out. If this goes to zero, your dividends basically paid for it. You know what I mean? So dividends paying for high risk. Then your 8K, right? You have about $8,000 left. Now, instead of flipping NFTs with this, you're going to find something else. You do need a skill, a passion, a hobby, an interest, something that you are an expert in. This could be cars, right? This could be cards, like literal trading cards. Shout out to One Piece. That's where I get the hat from, by the way. It could be TVs, like my buddy Jay Millennial. It could be tickets. Don't hate me, people. Don't hate me. My dream is to become a ticket reseller and be hated by the world. But that's also a different TED Talk. How many TED Talks am I doing? Anything like that. And your goal is to get more than 10% returns on every trade and every flip, investing as least amount of time as possible. But this is active, right? This is active money. This is not your Dogecoin fund. This is your Dogecoin fund right here, 0.5%. This is where you could fool around. This is active money that you are using your imagination to move. And when you put all of this together, I believe that you are in a position to get some nice returns. Now, is it possible that all this fails? I would say no, right? I don't think that DC Comics NFTs is going to disappear. And even if it does, the 2K that you invested in it, I don't think is going to make a huge difference if it disappears. And when you have 2% dividend from all these other positions that's coming in, I don't think that SCHD is going anywhere in the next 50 years. It might, but I don't think that it is. Index funds aren't stopping. Cash, Chase Bank, Bank of America, I think they're going to be here for another 50 years at least. Well, maybe not Bank of America, but I'm just playing, guys. That's my bank. Shout out to my bank. All right, guys, if you enjoyed this video and you got some value out of it, drop a like, share it with a friend, share it with Instagram, and be like, yo, I watched this video. You could actually share it on YouTube. There's a share button somewhere down below, and you share it and you'd be like, yo, Funancialism has an awesome video of how to invest $100,000, how to manage $100,000. Now, your friends might be inspired, and now you're talking about the same thing, talking about money, you making money moves, and I gotta move now because I gotta blow my nose. This COVID thing's got me full of myself like the devil just ate. Probably candidate, running the race. Look at my face. Okay, I'm out of here. Peace in.